As we enter the first quarter of 2026, the global automotive industry stands at the precipice of a profound structural transformation, a period that future economic historians will likely term the Great Recalibration. The previous half-decade was characterized by a euphoria of unrestricted capital, aggressive electrification targets, and the meteoric rise of special-purpose acquisition companies. That era has officially ended. The narrative of inevitable exponential electric vehicle adoption, which drove valuations to dizzying heights in 2021, has collided with the friction of macroeconomic fundamentals, interest rates, supply chain geopolitics, and, most critically, the limits of consumer affordability. This is not a story of failure, but a story of maturation. The froth has been blown off the market, revealing the bedrock of actual demand and actual costs. To understand the 2026 landscape, we must dismantle the simplistic binary narratives EVs are dead versus ICE is dead that dominate popular discourse. Instead, we posit that the industry has entered the trough of disillusionment phase of the classic Gartner hype cycle. The EV bubble that burst in 2024 and 2025 was primarily a financial phenomenon, distinct from the industrial transition. While stock prices of pure-play EV startups collapsed, wiping out tens of billions of dollars in shareholder wealth, the physical adoption of electric vehicles continued to grow, albeit at a linear rather than the promised exponential rate. Global electric car sales exceeded 17 million in 2024, capturing over 20% of the market. However, the deceleration of growth rates in Western markets has triggered a cascading series of strategic pivots among legacy automakers. By the close of 2025, the U.S. market witnessed a phenomenon that many evangelists deemed impossible: a plateau. Total EV sales for the calendar year 2025 settled just shy of the 1.3 million units sold in 2024. This represents a slight contraction in absolute volume and a stabilization of market share at approximately 7.8%. While global sales remained robust due to continued growth in China, the North American and European markets hit an affordability and practicality wall. The fourth quarter of 2025 was particularly instructive. Sales collapsed to their lowest point since 2022, a direct consequence of the expiration of the $7,500 federal tax credit in September 2025. This cliff edge effect demonstrates the fragility of demand. The market was not sustaining itself on organic consumer desire, but was being propped up by subsidies. We are now observing a three-speed world, each operating under different regulatory pressures. North America is characterized by a pullback mentality. Political resistance to mandates has grown, and with the regulatory pressure to force EVs into the market abating, automakers have adjusted their production mix. This has resulted in a resurgence of internal combustion engine and hybrid inventory. The U.S. consumer, facing high interest rates, has rejected the premium pricing of early EVs. The days of the early adopter, driven by novelty and ideology, are over. We have entered the era of the early majority, a demographic driven by utility and value, and the current EV offerings largely fail to meet their strict economic criteria. Europe, once the aggressive leader in climate policy, faced stagnation in 2025 due to the stop-and-go design of EU CO2 targets. Automakers, anticipating tighter regulations in 2026, deliberately held back model launches to ensure compliance for the penalty years. Furthermore, the removal of subsidies in Germany caused an immediate cooling of demand. In stark contrast, China continues to accelerate. With EV and plug-in EV sales reaching market dominance, Chinese OEMs are now grappling with massive overcapacity. This has led to aggressive export strategies that are causing geopolitical friction globally as Chinese manufacturers seek outlets for their production surplus. A critical insight into the 2025 data is the distortion caused by policy deadlines. The surge in sales seen in Q3 2025 was not organic growth, it was a pull-forward event. Buyers rushed to complete transactions before the tax credits expired, effectively draining the demand pool for the subsequent quarters. This volatility wreaks havoc on supply chains. Automakers ramped up production to meet the Q3 surge, only to be left with swelling inventory in Q4. This inventory glut is a financial anchor. Unsold EVs depreciate on the lot, and in a technology sector where new becomes obsolete rapidly, holding 2025 model year inventory into 2026 is a recipe for deep discounting and margin erosion. If legacy automakers caught a cold, EV startups contracted pneumonia, the period from 2024 to 2026 will be recorded as the great cull of the SPAC-era companies. The bankruptcy of Fisker Inc. serves as the grim archetype. Fisker's asset-light model, intended to avoid production hell, resulted in a loss of quality control. When Fisker filed for Chapter 11, it triggered a collapse of the ownership experience. The most chilling aspect was the cloud severance. Modern EVs are connected devices. When a manufacturer fails, the servers supporting the mobile app and digital keys are at risk. A Fisker Ocean, purchased for $70,000 in 2023, trades for pennies on the dollar in 2026, viewed by the market as an orphan vehicle. Amidst the wreckage, Rivian and Lucid have emerged as likely survivors, though not without scars. Rivian's survival was secured not by market sales alone, but a strategic lifeline from Volkswagen. The $5.8 billion deal provided the capital bridge necessary to survive the launch of the R2 platform. However, Rivian remains deeply unprofitable. Lucid follows a similar trajectory, anchored by the sovereign wealth of Saudi Arabia. With 2025 production reaching roughly 18,000 units, Lucid remains a niche player. Its survival is less about commercial viability in the open market and more about its strategic value to its state-backed patrons. While Silicon Valley burned cash, the dinosaurs of the industry executed a strategic pivot that has redefined the market in 2026. Toyota's reluctance to commit fully to battery electric vehicles, once criticized, is now viewed as prescient. By 2026, Toyota secured its title as the world's best-selling automaker for the sixth year in a row, driven by hybrid ubiquity. The consumer logic is irrefutable. A standard hybrid offers 50 mpg, requires zero behavior change, costs significantly less than a BEV, and commands higher resale value. For the average family facing inflation, the hybrid is the rational economic choice. Ford Motor Company's pivot in 2025 was dramatic. Recognizing that its EV division was losing billions, Ford aggressively reallocated capital towards hybrids. By 2025, hybrids accounted for 30% of Ford's volume. This is a customer-driven shift. Ford stopped trying to force the market into Lightning trucks and instead met the market with efficient work trucks. General Motors, meanwhile, has emerged as the most successful legacy transitioner in the pure EV space. After years of struggles with the Ultium platform, GM hit its stride in 2026. The success of the Equinox EV proves that there is demand for non-Tesla EVs, provided they are priced correctly and supported by a service network. The most acute pain point in the 2026 market is financial. The total cost of ownership models have been shattered by catastrophic depreciation. In 2022, EVs were selling for more than new ones. By 2026, the bottom has fallen out. Aggressive price wars initiated by Tesla repriced the entire used market. This has created a crisis of negative equity. In Q4 2025, the average amount of negative equity on a trade-in hit a record $7,214. A consumer who owes $40,000 on a car worth $20,000 is trapped, effectively removed from the new car market for years. The final nail in the cost coffin is insurance. In 2026, insuring an EV costs significantly more than a comparable ICE vehicle, up to 75% more in some states. This is driven by severity rather than frequency. A minor collision that dents the battery casing often forces a complete battery replacement due to fire risk liability. With replacement packs costing upwards of $15,000, insurers frequently write off the vehicle. For the budget-conscious consumer, the monthly savings on gas are instantly wiped out by the increase in insurance premiums. While the West struggles with demand friction, the East grapples with a supply tsunami. China's industrial policy has succeeded too well. The domestic Chinese market cannot absorb the production of BYD, Geely, and SAIC. The result is an aggressive export push. The most visible symptom is the logistical paralysis at European ports. Ports in Belgium and Germany have become de facto parking lots for unsold Chinese EVs. Thousands of vehicles sit exposed to the elements as distributors struggle to find buyers in a cooling market. This glut has forced heavy discounting, further destabilizing the pricing structure for European OEMs. A critical pillar of the EV bull case was the imminent arrival of solid-state batteries. In 2026, the industry must admit this timeline was a mirage. Toyota